Welcome students. In this edition of live virtual classes, ICAI Ashish Gupta welcomes you all. Student, in this session, the paper is Advanced Financial Management and the topic is Financial Policy and Corporate Strategy. So let us start the discussion. Of course, student, during the session, you are free to ask your query at the query handle. And of course, we will be open the session for after June, so you can ask the query directly also. Okay, students. So let us start.
இங்க ஆன் பண்ணுமா?
Now, students, initially, I will take you to the basics, overview of the syllabus. Because overview of the syllabus is very important to understand, as it is ultimately help us to understand what is the coverage or what is the framework within which our paper is set. Because what happens whenever there is any for the paper setter, normally we provide the not normally we provide the first basis is a syllabus. So overall, the paper setter has to set the paper within the overall coverage, or we can say limits of the of the syllabus. So now when we talk about the syllabus, so first of all, we should understand what is the objective of this paper. Okay, what is the objective of this paper? What is the main objective? Now, if we see, the basically purpose is the ability to acquire apply financial management theories and techniques in strategic decision making. Now, when we talk about financial management theories, student, of course, the topic of financial management is not new to you because you have gone through the same topic at your intermediate level. So, very importantly, you should understand what we have learned at financial management level in the paper at an intermediate level, because there are many concepts that has been covered there, like time value of money, and or we can say cost of capital and NPV, and there are 2 or 3 or more topics. Even you can say, even to some extent, working capital management that has been covered in at intermediate level will be help to you. So overall, we can say it is an advanced version of the financial management that we have covered at intermediate level. Now here our purpose is to making the strategic decision making, because once our level is escalated, we have to make the strategic decisions in the organization. Now when we talk about the syllabus, student, our syllabus has been divided into 6 sections. Okay, so our sections are like that. Say, first section, we are covering the 3 topics that we will discuss now. Now, first topic is basically the financial policy and corporate strategy. Now, basically this topic is theoretical oriented, of course, but numerical questions can also be asked from the same topic. So my request to you, please don't pay heed to the rumor, just go through the theory only from this topic. This topic is equally important from practical aspect also. Now, when we talk about what are the covered in this topic, so first of all, the main topic is covered advanced role of CFO in the various matters, including value creation. Now, time has come when the role of CFO has gone beyond the numbers, because they have to take the very other decisions like supply chain, risk management. There are other roles has also been covered in their profile also. So now the advanced role of CFO has been advanced. Then next it comes a strategic decision making framework. We have to see under which framework we have to make our decision making strategic decisions, so that we have to see our financial constant, other constant as well. Now next it comes the interface of the financial policy and strategic management. When we talk about the financial policy and strategic management, of course, the financials or we can say the financial resources of the company are a very important part or the constituents in any strategic management decision, because all strategic management decisions have to be taken in considering the fact that what we are financial resources already we are having and what we can acquire from the market or from the other sources. Now, next is balancing financial goals versus sustainable growth. Now, today's class will be concentrated on this sustainable growth rate topic also. What is sustainable growth rate? Sustainable growth rate, growth that can be maintained. We will see sometime what happens that a company may grow in a very fast manner. So we can say that of course it is growing well, but sometimes it is not good. Why? Because it is very important to maintain or to sustain a, we can say, a particular type of growth rate, rather first you go up then you go down, because once you reach on a top and then fall down, it not leads to the loss to the investor, but it also it leads to the loss of confidence in the company. So it is very important. Okay, so first topic, this is a first chapter of the section 1. Okay, student. Now next we come to the risk management. Now it is risk management topic is basically a broad topic. Of course, the you can say that its the area is not limited only to very small portion, but overall risk management is a kind of a risk management of the overall business unit. However, here in this paper AFM, our concentration shall be on the mainly financial risk. Here, we shall consider here financial risk only, because we are concerned with the paper of financial management. So we shall concentrate on the various kinds of financial risk. Of course, we have started our chapter with the various types of risk that are faced by an organization. But please remember, there are n number of risks, but this list is illustrative only. Okay, this is not the exhaustive, because there can be n number of risks. Different kind of a risk comes into the picture. So we cannot say, but however, we have just covered the very important type of risk in this in the first section, you can say first para or the first topic of this chapter. Then we come to the evaluation of the financial risk. Now, when we talk about the financial risk, this risk can be credit risk. Okay, this risk can be foreign exchange risk. This risk can be interest rate risk. Okay, liquidity risk. So all these are risks are there. Okay, but we from this paper point of view, normally we shall cover foreign exchange risk and the interest rate risk that will be considered in our forthcoming discussion. Now, next is comes the value at risk. Now, student, when we talk about the value at risk, this is an important measure, and this has been started utilizing somewhere around in 1990s. Now, value at risk, it is a mean what is the maximum possible loss. Okay, because this is studied based on our analysis of the past trends. We determine, and accordingly we can take the position in the market, because it is very important to understand that, student, when we take a position in the market, we have to see what will be our loss or what will be our maximum loss we can bear. So even there are where when we have a confidence levels are attached. Okay, that like confidence level are, this is a 90% confidence is that my loss will not be more than 5%, or we can say that with a 95%, my loss will not be more than 3%. So all this we can say is a kind of a discussion that is covered here. Next is evaluation of appropriate method of identification and management of risk. It is a very small description, because we shall cover discussion later in the later part of our studies, when we take the many topic like foreign exchange risk management, interest rate risk management. Okay, so student, this is a brief about this, and this is also covered in the under the part section 1 of the syllabus. Okay, student. Now next we come to the very another important topic, capital budgeting decision. Now this topic is not new to you because you have covered this topic at your intermediate level. At intermediate level, when you have covered this topic, there you have covered what are the various techniques of the capital budgeting like NPV, IRR, pay, profitability index, PI. Okay, even in the payback you have incorporated like uh, present value factor also is there. So there you have studied the basic techniques. Now here the advanced version comes into the picture. How? Because see, capital budgeting, when we have studied at intermediate level, there are some assumptions that we have made, like there are no inflation. Okay, there are the cash flows are to some extent are sure or certain. Okay, but here what happens in practical words, the things move differently than we consider. Okay, accordingly, in this advanced capital budgeting topic, what we shall consider, first topic we shall consider inflation, the impact of inflation on the, one second. So we shall consider here the impact of inflation on capital budgeting decisions. Okay, so here inflation we shall see how we can incorporate the inflation factor, because what happens, what is inflation? Inflation is means that is the money is losing its value. Okay, purchasing power losing its value. A commodity is worth rupee, we are purchasing at 100 rupees today, may be due to inflation after 1 year it is same commodity, same quality, everything is same, maybe cost us as 105 rupees 105. So this is called inflation. Okay, there may be other reasons. If the it says the manufacturer say ki what I can do, the manufacturing cost or the cost of raw material has been increased, wages has been increased. So all this indicate that there is an inflation in the economy, and that's why its price has been increased. Then next we consider the impact of change in technology on the capital budgeting decision, because today the time is changing very fast. Okay, technology making everything redundant. So that we are considering basic aspect, simple impact of the technology change in the capital budgeting decision. Next, we consider change of the government policies on the capital budgeting. It is very important. Sometimes what happens, uh, government policy also impact our decisions. Tomorrow, a policy may ban our product, may ban our services. So all these have a very huge impact. So we all consider here. Now, next is very important, and that is dealing with the risk in capital budgeting. Now, when we talk about dealing with the risk in investment decision, it is one of the very important topic. And normally, all the topics are covered here, like risk-adjusted discount rate. So all the topics will be there. Don't worry, we shall discuss in them in detail in forthcoming classes. Now, next is the internal and external factors affecting capital. This is purely theoretical kind of a thing. Now, next we comes to the advanced capital budgeting decisions. Now, when we talk about the advanced capital budgeting decisions, the method of incorporating decisions are here covered in the capital budgeting. So all here we can say that topics like decision tree, all the approaches shall be covered here. Now, next is the adjusted present value. Adjusted present value basically method comes into the picture when like you have studied when you were at your intermediate level, when we were discussing the topic of capital budgeting. There normally what is assumption that the capital structure of the company shall remain the same. Okay, if we are taking any new project, the capital structure will remain the same. So what happens, normally we used to consider WACC, that is weighted average cost of capital, or hurdle rate. to discount the associated cash flows. But sometimes what happens, there may be a difference in the capital structure on account of, say, taking the new loans. So it may be possible that a company for a new project may be taking a a separate loan for the same. So in this case, what happens? We get the tax benefit of the interest paid on loan. So what happens? Normally we consider, so first of all, we calculate the base NPV. Okay, and in this we add the present value of the tax saving on the interest. So that's why this is called adjusted present value. Now next is comes the optimum replacement cycle. Here in the optimum replacement cycle, the decision is taken regarding when to replace. Of the time, the repair as a salvage value start declining. So somewhere company has to decide when to replace its asset. Okay, when the company has to replace its asset, it is very important. So because sometimes it happens in normally in the companies where, like for I just give you a very small example. Now a company may have a taxi fleets. Okay, sometimes a company may not Ola Uber. Ola Uber is only a aggregator. Okay, they don't own any car. Okay, they only own the app or the system. But I'm just talking about because in some countries there are some, or even in the India, there may be any transport company which owns the taxi fleet. Now they have to take decisions after how many years they have to replace their taxis or the cars. So this is called optimum replacement cycle. So all will be covered here. So this part is also covered in the section 1. Now next we comes to the security analysis. Now this topic is a security analysis. It is very important. The student just hold on. I just checked whether we have received any query. One second, student. Yes. Okay. Okay, beta. Some students are saying good morning. Khushi. Okay, beta. Jini Kumari. Uh, Jini Kumari and K Pashan. Good morning, beta. All go. Okay. I think it is clear now. Okay, student. So let us see. It is. We are now coming to the section 2. Okay, this is the starting section 2, security analysis. Now here in this security analysis, the first topic is fundamental analysis. Now what is exactly security analysis? Security analysis means uh, when we talk about any buying of any security, okay, so normally security, of course, there are type of a number, there are other types, okay. There are many types of securities. So like it can be fixed income security. If we talk about the debenture or bonds, then it comes the equity. This is basically a kind of a equity participation in the company. Now, when we talk about the security analysis, basically security analysis says when we talk, we have to acquire any security. So now question comes, how we acquire the security so that our profit is maximum. So fundamental analysis is basically called for, we can say it is also called EIC analysis. Okay, EIC analysis means first we have to see in which economy we have to, like for an investor, they have to see some there are like JP Morgan and some there are big investors. Normally what they do, they carry out a detailed analysis. First they see in which economy they have to invest, in the economy, in which industry they have to invest, and in the industry in which company they have to invest. So they carry out a broad analysis. Okay, so before investing in any company, they carry out the overall analysis of a like companies and in an economy. They see the GDP growth, many factors, employment rate, many factors they consider, inflation rate, macroeconomic factors are generally considered in the GDP analysis. Industry analysis, they see how the industry is performing. Like in 2000, there was a boom time for dot-com industry. Now today's time, it is a time of AI. Okay, so now AI is everywhere. So of course, AI is industry we can say is booming these days. Now here, now if they will select any IT company which is accelerating uh, in this artificial intelligence. Like there is company, I think its name is Nvidia. Okay, in the USA, they are basically in a manufacturing chip relating to AI, something like that. So there, it may be possible that a investor may invest their money there. Now next is come the technical analysis. When we talk about the technical analysis here, while the fundamental analysis have a long-term horizon, the technical analysis normally have a short-term horizon. Here, the technical analysis is totally different. They don't go by the fundamentals. They see today the share price is this, and as per the history trend, this will go this level, then it will go down. So we can say that we can identify. Just I am saying you for the just the share price is moving like that. So sometimes the analyst may the technical analyst may analyze that the share price will move from here, it will reach to this level, then ultimately it fall down. So what they will do, they buy with this at this level and they will sell at this level. Now identification of this level, that is buy at low and sell at high. This is the basic fundamental of the technical analysis. So we have overall it is a fundamental of the portfolio management or profit making, but when to buy is basically we come from the technical analysis. So they will buy from somewhere when the prices are low and they will sell when the prices are at its peak. So this is all are covered in the technical analysis. Of course, there is one very important topic here. Of course, like we shall cover chartist technique, theories and principle, assumptions and meaning. Now, student, please hear it and note that technical analysis is a very wide topic. Okay, even it is a subject in itself. However, we have kept the coverage of cutting analysis very limited here, only for the just basic understanding. Now, when we talk next, we come to the topic of efficient market hypothesis. So when we talk about the efficient market hypothesis, is it theory is basically we can say that it is related to the fact that market discounts everything. It means market reacts to any information. Market reacts to any information. Like here in the recently when the poll results are coming were about to come. Okay, when the first phase of the when the results are coming out. Okay, so market has reacted to it the same. Okay, market has started reacting to for the same poll result. So this is called efficient market hypothesis. We shall see there are three theories. Okay, then we come to the last topic, equity research and tools available. Where are and many tools are available in the market on the internet. Even they are be free of cost and they are free basically free of cost or they are the chargeable basis. Okay, now next we come to the next topic of the section 2, that is security valuation. Now student, when we talk about the security valuation, so here we start with our theory of valuation, very basics, return concepts. Okay, now when we got then we come to the concept of equity risk premium. Now student, at your intermediate level, you may have gone through the formula of CAPM model. Okay, where the formula was like that, KE is equal to RF plus beta into RM minus RF. Basically, this is the market risk premium and overall this it is called that is called your equity risk premium. Means beta means the systematic risk. Okay, beta means systematic risk, and that is a overall discussion we shall take in the next topic. Okay, so here we see that what is the risk attached, what is the how much premium we expect for as per the risk level of the security, that is called equity risk premium. Okay, so this equity risk premium is added with the risk-free rate. So overall, we get the cost of equity that is used to analyze our security valuation. Now, student, this topic is security valuation is very interesting topic. Okay, very interesting topic in the sense that student, you have studied the topic of the cost of capital at your intermediate level. Okay, you must have gone through this topic at your intermediate level. So where you have calculated three type of cost. One is KP, cost of preference share, then KD, then KE. That is cost of equity. There, what is used to happen, you have been like, if I take the case of KE, there the formula you must have used D1 upon P0 plus G. Okay, now here this value has been provided to you, this value has been provided to you, this value has been provided to you, and you have been asked to calculate this. Now, when we talk about security valuation, it is linked to this topic. How it is linked to the topic? Here we shall be given this value KE. We can say this much of return we expect from the market. Okay, when we have been given this value, so what will happen? This value will be with us. This value will be us. We have to calculate this value. That is how much justified price I should pay for any particular buying the security. And that is from this even we can compute whether the share is undervalued or overvalued. Now suppose if I have been given some figures, okay, and from this figure I compute this value P0 50 rupees per share. Now in the market, if it is trading at 70, so it is mean it is overvalued. It does not deserve this much of amount. So it will be called overvalued. Now, if it is the same is trading at 45 rupees, it will be called undervalued. Okay, because it is have a more value, but it is trading at. Similarly, when we talk about the debt, here when we talk about the debt question, here we used to use the IRR method. Okay, there we should IRR method, and somewhere I just take you to there, and there what used to happen, we have been used to do like this, KD plus I plus KD raised to power 2 or something like that, the redemption amount, redeemable value, or we can say plus I in the last year 1 plus KD raised to power n, and this should be equal to the price of the security. Okay, now this value used to be unknown and we used to calculate the same. We used to calculate the same by using IRR method. Now, when we talk about cost of debt, this is basically also called yield to maturity. Okay, now when we talk about the topic of security valuation, we shall be provided with this figure. We shall be provided with this figure. Okay, we shall be provided with YTM. Okay, and what we need to calculate? We have to calculate this P0. Okay, accordingly, so what we shall do? We shall be provided YTM plus say 1 plus say it is raised to power 2, goes like that. So ultimately, say if I am talking about the if figure that is redeemable after 3 years, so I will be provided with this value, I will calculate the discounted value of associated cash flows with the security, and we will compute the value of the bond or debenture. So we can see that ultimately what we have covered at our intermediate level, it is the mirror image or basis of mirror calculations of the various uh, variables, basic calculation various variables there that we will do here. Okay, friend. Now required return on equity discounted section for the relation to cash flows. So now this is all theory covered here. Now here, when we talk about these are the covered, next it covers the approaches to the equity valuation. Okay, then it comes the valuation of preference share. Then it comes the valuation of bond and debenture. So all these three are will be relating to our cost of capital formulas. Now, next it comes a theoretical topic, role and responsibilities of the valuer. Nowadays, the role of valuer has been become very important because nowadays the valuer services are used for many purposes. Even there is a new career in the valuation for the chartered accountants as well. Many CAs are becoming valuers are nowadays. Okay, because it is used for many purposes. Like important purposes are merger acquisition that we will discuss later on. When and one company is acquiring another company, so they have to get it valued how much amount I should pay for this company. Then we can say there is evaluation of securities as well. Okay, when we have to acquire a company by purchasing their shares, so you have to see whether it's justified or not. Even now, the valuation of business has come important in the divorce proceedings, because for the claiming by the spouse for the business in the business, it has also become very important. Now, next is coming the precautions to be taken by the valuer before. So all these theoretical aspects are here. Now, next next section where comes to this. So again, this topic was again section 2 topic. Okay. Now, I am coming to the last topic of this section, that is section 2, that is portfolio management. Now, student, portfolio management is one of the very important topic for this AFM paper. Okay, because portfolio means we can say it is a combinations of some assets. It can be types of the various assets like real estate, gold, equity shares, preference share, equity shares, or we can say financial securities, gold, real estate. So these are broad categories. Now within the financial assets, within the financial securities, we can have a portfolio of equity, fixed income securities, bonds, etc. And in equity shares, we can have the different shares of the company, shares of the different companies to diversify the risk. So basically, this topic is concerning with the diversification of the risk. How the company diversify the risk? Because the basic funda is that the topic, this very topic is basically depends on one of the very important concept. Don't put all eggs in one basket. This is a basic logic. How? Because if the basket falls, all the eggs will be broken up. So it is always better you just divide the eggs quantity into different buckets. At least if one bucket fall down, the remaining eggs will remain the same. So here we shall consider portfolio analysis, portfolio selection, capital market theory, portfolio revision. So all topics are there. Even we shall cover here asset allocation. Fixed income portfolio means basically this analysis is concerned with the investing in the bonds. Okay, risk analysis for the investment in distressed securities. Now, what is distressed securities? Very important concept. Distressed securities means sometimes what happens, a company may be bankrupt. Okay, a company may be bankrupt. Even though the company is a bankrupt, the other company may buy it. Why? Because the share of the same company or the securities of the same company may be selling at a junk price. That is also sometimes called junk bonds. Okay, so they are selling at a very lower prices, it may be possible that tomorrow if the company revive, the prices will be shoot up. Okay, and you will make the huge profit. So all these are covered here. Next is comes the alternative investment avenues. Now, student, the days are the gone when the investment avenues are limited. Now, today there are many investment avenues are available. That is beyond our imagination, like hedge fund, estate investment trust, mutual funds, and gold and other things are there. So mutual fund, of course, is a part of our discussion, but in there we shall see real estate investment trust because where and there are other avenues also. So all are briefly covered here, very briefly, because of course for the detailed discussion we shall take it separately. Now next, that topic comes for the section 3. It starts with the securitization. Now, students, what is securitization? Securitization means, students, it is kind of a converting the illiquid assets into the liquid assets. Now, what happens? A company who has sold the goods on credit may have a huge amount of receivables in their balance sheets. Now, when they have a huge amount of receivable in their balance sheet, so don't have a liquidity because debts are illiquid, cash is liquid. So of course they will be converted into cash, but they will be converted into cash at some later point of time. In this case, what happens? They transfer all the receivable to some special purpose equity vehicle. Okay, and that special purpose vehicle issues the security backed by these receivables in the market. Okay, the money comes from this issue of securities is transferred to the from special purpose vehicle is transferred to the originator company. So by this, the originator company gets the money. Okay, so what happens? I show you just simply. Now say the company may have a receivable. Okay, they transfer receivable to special purpose vehicle, and special purpose vehicle issues the securities. Okay, now what happens when they issue the securities? The cash comes to SPV. SPV transfers this cash to originator. Now by this, the balance sheet that was covered with the receivable comes with the figure of the receivable comes down and the figure of cash in hand goes up. Now what happens when it has risen converted? So what happens later on? The receivable will pay the cash. Okay, ultimately this cash will be going to refund the securities. So by this, the investor who have bought the security for some time may will get some income because this security will be at a discounted. Of course, if the originator has transferred 100 rupee of the receivable, the securities will be issued somewhere around 94 because 6 rupees will be of the interest amount for the 1 year. Maybe, and I'm just giving you a small example. So this 6%, 6 rupee income will be for the this security. So this is called securitization. And now the securitization is popular because even some banks are buying these securities to make their balance sheet as per the RBI requirement. So all this has been covered here. Of course, this topic is more theoretical oriented. Okay, but still, any just basic you should cover. Unlike here, the concept of tokenization is also covered. Basically, tokenization means we issue the token, like it is a kind of a small amount of the some digitally token like there that can be transferred or that can be stored, etc. Now next comes the mutual fund. It is very important. This is another part of the section 3. Now when we talk about the mutual fund, one second. Okay. Okay, now student, here it comes a topic of mutual fund. Now mutual fund basically means uh, when the some money is pulled together. Money is pulled together because I just give you a very small example. Okay, I just give a very small example. Now suppose the share of any particular company may be worth rupees, trading at 5,000 rupees. Okay. Now suppose you have rupees 500 with you. Okay. But you can buy the share because what happens? Uh, this share is one. Okay. You cannot buy 1/10 of the share because there is no concept of fractional shareholding in India presently. So you want to buy the share, but you have only 500. Or I say I just make it 1,000. It will be a bit easy. Okay, so you cannot buy two five, but two oblique five of the share. Suppose similar to you, or small in your office, you ask your desire, express your desire before any friend. Your friend may have the same desire. Similarly, 5% like you combine together. Okay. Ultimately, you see, you say, of course, we cannot buy fractional shareholding, but what we can do, we all can combine our money. Sorry, it is my mistake. It is 1/5, not 2/5. It is 1/5. Okay. So what you do, you all the friends join together and pool the money 1,000 plus 1,000 into 5 rupees 5,000. Okay. And you buy one share. Okay. Okay. It is clear now. Now what happens? Each of you will have of holding of 1/5, 1/5 unit, 1/5 share. Okay. You will have a holding of this company of 1/5 share. Now tomorrow, if company declares a dividend of say rupees 100. Okay, so this will be equally divided into your five friends. Rupees 20, rupees 20, rupees 20, rupees 20. Okay, so by investing 1,000, you are getting the income of dividend even of rupees 20. So this is concept of pooling of the money and investing in the security is called the mutual fund. Okay, it is called mutual fund. And this mutual fund is nowadays has become very popular, and it is one of the very popular vehicle for the investment. And many investors park their money in this same. One second. Okay, student. Now next is come the topic of derivative analysis and the valuation. Okay, now this is the last topic of the this section, that is section 3. Okay, now here in this topic, derivative and analysis. Student, this derivative analysis is, I am sure it is not new to you, because nowadays most of the students are very well aware about that, and even students who are going through the financial newspaper, this derivative topic is very common for them. Now what, because if we talk about the derivative in our time when we were doing the CA, the derivative topic was not that much common. We have to refer the books, etc. But today's there's a plethora of knowledge of the on the website, etc. Of the derivative. Derivative is means the deriving something from some underlying set. Basically, it is, we can say, we do some trading. We do some trading based on the value of something. So derivative is basically a kind of a, you can say, kind of a contract, kind of a contract. Now, when we talk about the derivative, here I will make a disclaimer, even all our classes, this derivative discussion covered in the ICAI syllabus is mainly for the academic purpose only. So students are advised not to indulge yourself in derivative trading from the market, because it will ultimately lead to a loss. Okay, even with a report of the SEBI, and that is there are 9 out of 10 derivative traders making losses. So my request to you, please, before you become the CA, don't indulge yourself in the market. Yeah, this all these activities, derivative. Here you in the CA examination, just you concentrate only from the academic point of view, because practicality application may be different from what we are studying here in the theory. Here, our purpose is, of course, derivative can be used for basic. Our here, if I say you, so our here, the main purpose of derivative, making you understand the derivative, is basically hedging the risk. Of course, we have explained how we can speculate here from the derivative using, but our main purpose is here to hedging, how we can derivative can be used to hedge the risk. So there we have covered forward, future, and options, future markets, pricing theories. Okay, options. This option also includes the pricing and what are the various, like there are concept of Greeks. So all the nitty-gritties have been discussed here. Our next topic is the credit derivative. Now, student, it is one of the very advanced version of the derivatives, where in credit derivative, what happens? Here the credit risk is hedged basically. Because credit risk has, suppose I am buying in the bond of a company. Okay, so and I am not, I may have a apprehension that the company may default on the payment of interest or my principal amount. So what I do, I approach to a bank and I say I want to buy the credit derivative. Okay, they will sell me the credit default swap. Okay, but they will say they will charge some premium. Of course, they are not free. They will charge some premium and they will give you the guarantee. If the company fails to pay any on any part, like interest payment or the principal repayment, we will make you cover up the losses. Okay, we will make good to your losses. Suppose if company has to refund 1,000 and they refund only 400, 600, so this 400 will be covered my under credit default swap agreement contract. So this is credit derivative. Now, when we talk about real options, it is very interesting topic. Here we shall discuss capital budgeting, a blend of capital budgeting decision plus derivative technique. And mainly here we shall discuss the option. There is a contract, how we shall, it is a blend of the same. Okay, then derivative mishaps and lessons. Now, student, of course, derivatives can be used for the hedging, but in the history, it has been used to make the profit, short-term, quick profit. Okay, and ultimately this has led to collapse of the complete business. Very famous case, Barring Bank's case. Okay, 1995 case. It is a very important case, and we can say it is a kind of a landmark case. Okay, where the one rock trader has you can say compelled this bank to be bankrupt, and they did it made this Nick Leeson, its name was Nick Leeson, who has made this bank of 200 years old, more than 200 years old, England bank bankrupt. Okay, then we have a swap agreement, commodity derivative, whether it. So generally here we are discussion are normally theoretical. but all these topics are normally numerical oriented. Okay, this is option, hedging, all these are topics are numerical based. So it covers a lot of. Now, student, this topic is very important because in the when we talk about in this derivative analysis here, our underlying is basically index number or stock prices. But when we shall cover our next topic, this is a section 4, first topic. Here I will show how the derivative is linked. Now, student, when we talk about foreign exchange exposure and risk management, this topic will be new for you. Now, in the financial management that has been covered at intermediate level, our discussion was regarding related to our domestic overall decisions, like where we have to invest. Now, when we cross the boundaries of the country, there is one risk come into the picture, and that is called foreign exchange exposure. Okay, so the decision relating not only capital budgeting, even if I am trading with a country outside India, I am exposed to foreign exchange risk. Why I am exposed to foreign exchange risk? I'll just give you a very small example. Now suppose if I am importing, because see, rupee is a valid currency only in India. Okay, rupee is valid currency only in India. Once I cross the border of the India, I have to buy or purchase the goods in their own currency. But what happens? There are some internationally accepted currencies, and in these currencies are like that. You have heard it is dollar, pound, euro, even Chinese yuan are becoming a global currency, and there is we can say Chinese euro or Japanese yen. So now these currencies are generally globally accepted currencies, on which the dollar is a very dominant, and that is always you have heard if the reading the financial newspaper, there is a drive to de-dollarize the world. Okay, there is now the countries are coming. Why should only we accept the dollar as a international currency? So when we talk about, so generally like some common currencies are used for trading the internet in the international business. Now suppose if I am exporting goods worth of 1 lakh to say country X. Okay, and today is the dollar rate. $1 is equivalent to rupees 81. Okay, generally what happens? Uh, 1 second. Generally what happens? Uh, the there is a time gap between the exporting of the goods, okay, or importing of the goods and making the payment or receiving the payment. So suppose there is a gap of about 2 months between exporting the goods and receiving the payment. Now, meanwhile, the price of dollar becomes rupees. I can say to not 80. It is just I take it lesser side 79. Now say today is 18th September. Okay, my amount this will come somewhere around 17. I'm just giving you a small example. Okay, so now what happens? Today I am expecting that I will receive 81 lakh out of this export proceed. But when the actual amount comes into my hand, okay, and I sell this dollars in the market, only the amount comes into my hand is 79 lakh. So there is a loss of 2 lakh. Okay. Similar thing also can happen if the price of dollar becomes 83. So my loss is there. Here I will have a profit of gain of 2 lakh. So here it is a loss. It is a gain. So we can say that there is a variation. Okay, there is a variation in this receipt, and accordingly, this variation is called the foreign exchange exposure or the risk. Okay, then how we manage all has been covered here. Initially, we start with the basics theory. Swift. Swift is basically a mechanism using which we transfer the money. The bank uses it to transfer the money and receiving the money. Then international payment gateways, all theory. Then we see how the exchange rates are determined. Okay, generally here we have covered the theory of interest rate parity, purchasing power parity, etc. Then we discuss about the foreign currency markets, because see what happens, or we have to when we have to want to convert our currency into the Indian rupees, we have to sell it somewhere in market. Similarly, if we are buying the goods from importing the goods from the outside India, we have to make the payment. So of course we have to buy the foreign currency. So all these are done through the foreign exchange market, currency market. Then management of foreign exchange. Here it comes how we manage this risk. Student, please note that it is very important that we have covered the topic of derivative here. So this derivative techniques, shall be used to manage this foreign exchange risk. Okay, student. So this shall be used here to manage foreign exchange here. So here our underlying will be foreign exchange. Here we have discussion. Our underlying was index number or the stock prices. Okay, student. Now next comes the international financial management. Now you have discussed this financial management at intermediate level. Now here we shall, in this topic, we shall cover the international financial aspect. Now this is another section. Your another topic for the section 4. Okay, so raising of, now here it is international capital busting. Capital busting we have covered. Now international capital busting means you are investing the money in outside India. Now in the capital busting you have covered at financial intermediate level. We have covered, consider all the cash flows in the Indian currency, and we have used NPV method, IRR method, or probability. But here we are investing the money outside India. So of course, as explained in the previous chapter, we are exposed to foreign exchange. So this here international financial management, we shall see how to evaluate our capital busting decision, keeping in view the foreign exchange involved. So this is called, it is a blend of a foreign exchange plus simple financial management. Okay, now it is similarly raising the source from the international sources. Like when we say raising the source from domestic sources, generally there are 3 sources are there. Okay, of course, bank loans are there, long-term loans are there, but there are one sources like equity, debt, preference shares. So all these are domestic sources. Now here we shall see when we have to take the money from outside. Here, if you are reading financial newspaper, you must have come across the term foreign currency convertible bonds. So these bonds are issued by the company to the outside India. Similarly, you must have heard the name of masala bond. Okay, masala bonds are basically rupee denominated bonds, but they are issued outside the boundaries of the India. So all are covered here. And sovereign funds. Okay, sovereign funds means that countries, some have a surplus of money, they invest worldwide. Okay, this is called sovereign funds. Then it comes the international financial center, that is Gift City. This is Gift City in India, is in at the Ahmedabad, near Ahmedabad, Gandhinagar, where in the Gift City, it is a kind of a international center. Okay, where generally it is treated like a foreign country, foreign and foreign. You can say it is called a offshore space within the boundaries of a country. Here the rules are different. Here the rules are different from the domestic rules. Then it comes the international working capital management. So similarly, all these topics you have covered here in your intermediate level. Only the international aspect will be touched upon here. Okay, student. Now we are coming to this last chapter of this section, interest rate risk management. Now, when we talk about the interest rate risk management, is basically uh, what, how we, what is in, see, if we talk about the bond, sometimes we say that bonds are, if I am investing in the bond, it is not a risky, but it is wrong. Why it is wrong? I just give you a very small example. Now suppose today you are buying a bond, say of rupees 1000, and the bond is say 8% bond. Okay. So on this bond, you are getting an income of rupees 80 each year. Okay, the rate of interest is 8%. Now suppose, because as on date, the market rate is 8%, so generally some particular level, some particular credit rating. So here, now suppose tomorrow this rate of interest has come 10. Okay. Now question rises whether this bond will be sold at same price of 1000. So I'm just repeating. A bond, you have purchased a bond, say today, when the rate of market rate of interest was 8%. Of course, you are getting the interest income of 80. Now tomorrow, suppose rate of interest comes 10%. Now my question is to you, whether this bond will be sold at, will be, you can sell this bond at 1000. Think the same. The answer will be no. Why? See, here, if you ask, if I want to sell my bond at 1000, you will say no. Because why should I pay 1000 rupees for this 80 income when I am getting, by buying 1000 bond today, I am getting an income of 100. Okay. So he will say, how much price you will pay to me? I will say, I will pay the price of 800 to you. Why? Because if I invest 800 at the rate of, at today's market rate, only then I am getting this income. Because from your bond, I am getting income of 80. Okay, at today's rate of interest is 10%. So I will pay only 800. So how I have computed? Simply I have computed like this. 0.8 divided by 0.10 into 1000. So I will say I will pay only 800 to you. Now this fall of rupees 200 in the value of bond is risk. Okay, it is a kind of a risk, interest rate risk. This is called interest rate. So all has been covered here in this topic, how we consider hedging the interest rate risk. Similarly, so here basically we should cover what now. First is benchmark rate. Benchmark rate is a kind of a leading rate, or we can say it is based on which we normally add some credit point spread. Okay, this is a benchmark rate means suppose if you go to the bank and take a home loan, so bank will may say that I will charge repo rate, that is repurchase agreement rate, plus 3%. Okay, so benchmark rate is basically repo rate. Okay, I'm not here covering the what is exactly repurchase rate. So benchmark, even you must have heard the term of LIBOR, but please remember it is no more in existence. In the replacement of that, there is a SOFR. Okay, Estonia. Okay, Sonia. Okay, there are some rate. So here, these are rates are now there. LIBOR has been. So these are benchmark rate. Okay, even like in India, generally we use the MIBOR. Okay, prime lending rate. So all these terms are benchmark rate. Then we come to the hedging of the interest rate risk. Traditional that certain liability management. I'm not going for the same forward rate. So here the forward rate, that concept we have discussed in derivatives will be used here. Here the underlying will be our interest rate. Similarly, interest rate derivatives. So this topic will basically a blend of the derivative we have discussed there, and here our underlying will be the interest rate. So overall, a combination of this, we shall see how we can use the same. So I'm just giving a very brief, don't worry. Student, I'm just my purpose here to brief you about the syllabus. First you understand the syllabus, then you proceed. Now we come to the first topic of the section 5. Okay, here our topic is start with the business valuation. Now when we talk about the business valuation, this topic is basically covered the how we value the business. Now business, say we have discussed about the valuation of securities. Okay, we have discussed the valuation of securities. Now when we talk about the valuation of business, it basically covers valuation of business on the different perspective, from the various perspective. So some may consider asset-based valuation. Now asset-based valuation may be of useful where the company has an asset. Okay, but where the company may not have the asset, then what basis can be there? It can be earning based model, cash flow based models, because you are because you know that cash flow and the earning can be different. Okay, if I say the profit is equal to cash flow, you will say no. Why? Because there is a kind of a non-cash item like depreciation. Sorry, writing of expenditures. So that's why the cash flow may not be the same as the profit. So here we shall see what are the models for the cash flow. Then measuring cost of equity. Here we are considering the approach of CAPM, asset pricing theory, that is covered in the our portfolio management. So all are covered. Then relative valuation. Relative valuation generally, what happens? Sometimes to carry out the valuation of a new company, generally the basis of the old existing companies are used as a valuation measure. So this is called relative valuation. Then there is another approach to like economic value added, market value added, share value analysis, all are there. Then in the last becomes arriving at the fair value. So it is just a concept of the covering the fair. This is the valuation. Okay, then it comes the going concern and knowing bank valuation, valuation of distressed companies that I mentioned. The company have gone into the bankruptcy. Valuation of startup. Now, student, I need to invite your attention to the startup because nowadays it is a time of startups. Okay, nowadays it is a time of startups. Earlier there was a system that a company used to be started in the form of sole proprietorship, then becoming partnership, then becoming private limited, then becoming public limited. So overall there was a period of say somewhere around 15 to 20 years where once a business grows into the becomes matured into the company. But today the time has changed. You come out with a new idea, okay, and start a business, okay, and you become a startup. Once a startup, its valuation also a challenge, okay, because there are no profit, there are no track records. So how we value the startups is this cover has been covered. Then valuation of digital platform like Ola, Uber, like this. Then valuation of professional and consultancy firms. It is very important, but because nowadays even the consultancies firms are business taken over by. Then it comes a ESG value, impact of ESG. ESG basically economic, environment, social, and governance. Nowadays, these are the three pillars of any business. Why it is business? Because the government or the regulatory authorities are now becoming what we are giving to our next generation. Okay, so all the covered are here. Environment means basically we are covered with the environment. Okay, social means we have how we deal with our social, economic, and social environment. And governance means how we govern the business. Now all this has been covered in the chapter one. I will discuss there. Now next topic in the section fifth. Two chapters are there. So now it comes the once we have valued the business, now it comes the how we merger acquisition and corporate restructuring. Now, students, this is one of the very kind of a strategic decision. So, now it is a very kind of a strategic decision because now what happens? The company may have a fund or they may have some vision. They what they do, they start acquiring the companies, or even the two companies may be merging together and forming the new company. So, what all, of course, the merger acquisition are normally when we any decision is taken, there are various aspects have to be taken, like regulatory aspect, whether it is permitted under the Companies Act or whether it is permitted by Competition Commission of India. Okay, and whatever the taxation aspect. Here in the advanced financial management, we normally cover the financial framework. How, what are the valuation that we have seen and how we will discharge our liabilities all are covered here. Even there is one very important topic that is called defensive technique. Now, sometimes what is a defensive tactic? It is basically when any company want to save itself from a hostile takeover. See, if uh, a company's management approach to another management company that they want to acquire them. So it may be possible that the other company may be agreed. Then it is a you can say mutually agreed acquisition. What happens? The first company may start acquiring the shares from the market any price that becomes hostile takeover. Okay, that becomes a hostile takeover. And there was a first case that has been noted in Indian history. It is somewhere around in 1980s. There was a person called Savraj Paul. He has tried to take over the escorts limited by this hostile takeover. So then what are the defenses can be used as is covered theoretically there. Then there is the concept of reverse merger. Generally, what happens in a merger, a public limited company take the private limited company. But in the reverse merger, it happens the reverse. That is, a private limited company may take over any public limited company. Okay, so that is also covered here. Then we covered divergence. Divergence means it is opposite to the merger acquisition. Divergence means we are basically in a merger, two or three companies are coming together. In a divergence, one company is dividing into three parts. Now, while mergers are said to be a synergy oriented, we have a synergy objective in our mind. Divestitures mean we are unlocking the growth. Sometimes what happens, a company may have many businesses. Okay, so of course it becomes quite difficult for the top management to operate all the business units. So what they do, they start splitting of the business so that each business or each company having their own structure concentrate on their growth. So by this, now it is another concept. Recently, I have in the newspaper, I have come to know there was some company Snowy. Okay, they have demerged. Okay, and even get start delisting. So all this has been covered here. Okay, then ownership restructuring. Basically, this is the internal reconstruction. Okay, in this, there is no outside entity involved. Here, only the internal restructuring takes place. Then unlocking that this is a theoretical topic. Cross-border mergers. Cross-border mergers means once you cross the boundaries of the India. Then it is a special purpose acquisition company. Now, students, this concept is quite new in India. Special purpose acquisition company means these are the companies. They are mainly formed for the purpose of acquiring companies. That is, their purpose is just to acquire the companies only. Okay, so this is also called the blank check companies. You don't know where this company will go and acquire the which business. So this is the called special purpose acquisition company. It is not that much popular in India, but this is much popular in USA. Okay, student, now we come to the next, and this is the last section, section 6. Startup finance. Now, what is startup finance? Of course, we have talked about the startup, but startup finance is another challenge. Now, when we talk about the startup finance, the first thing comes into the pitch presentation. In a pitch presentation, you have to make a deck. On a deck, you have to make a presentation before you're the venture capitalist or the angel investors that I want to, I have this much of idea, and if this idea will be implemented, there will be this much of profit. So you have to present your business idea to get the funds. So it is a, you can say it is a kind of a stepping stone in the startup finance. Now next it comes the unicorn. Concept of unicorns, any private limited companies whose shares are not listed and having a value of more than $1 billion. Okay, this is called concept of unicorn. Okay, then we discuss the theoretically the startup initiative of the government of India. Okay, sources of funding. Okay, then it comes to the succession planning in the business. Now, succession planning in the business nowadays it is very important concept. Why it is so important? Because here now today, see what happens. Somewhere around 50 to 60 years ago, a person may have started a business. Today, this business has become a conglomerate. Okay, now see, initially, when a person may have started the business, he has to transfer his wealth to his son. Okay, he may have that this much of level of the business. Okay, so he may have said that you take this, you take this. But as on date, the business is like that. And even these two sons may have a further family members. So what happens? This succession planning become a challenge. How to transfer the business so that none of the party could feel that he has been he is a less privileged, nothing like that feeling comes. And overall, they have to see the business is success to the new hands very smoothly. Even there is a new challenge in the new business in the succession planning. The sometimes next generation may say that I don't want to take the business. I don't want to take the business. Now here the challenge come for the business. Who will take care of this business? Who will succeed or who will lead this business? So all that has been covered here. So because this topic is novel theoretical. Now student, with this, we come to the end of our topic discussion of the syllabus. Now my purpose here is not to make you worried that this is a huge syllabus, student, but I have given you an idea that this is the syllabus coverage that we shall have to cover here in our forthcoming classes. Of course, there are some theoretical topics, some are numerical based topic. Even I have came to know that some guy says that, okay, this is a theoretical topic, this is a numerical topic. But my request to you, even please don't ignore the theoretical portion of numerical based topics. Okay, it is a paper setter's wisdom that for his freedom, they can test from any part of the syllabus. Of course, we have given some guidelines that there is, it is, does not mean that you may ask or set the paper only from the one section. Of course, there are 6 sections are there, but how they will test you, we don't know. Even a theoretical question can be asked from the numerical topic. So please, my request to you, go through the ICAI study material word by word. In case you have any issue or you find any mistake or even you have find any issue, please do contact us at the board of studies. I will share my number with you in the end of the class as well, email ID also. So my request to you, please don't hesitate to contact us. Now student, with this, I first start my discussion with the topic financial policy and corporate strategy. In a 5 minute, I will take a break. Okay, but just before 5 minutes, I just start discussion financial policy and corporate. Now student, today, what is happening? The advanced role of CFO has been become, as I discussed with you, has become important. Now, what are their roles? Of course, I have discussed with you the risk management. Risk management is one of the core area now becoming the important role for the CFOs. Then supply chain importance management has become more important, especially in time of COVID. Okay, what is exactly supply chain management is it? Supply chain management is basically concerned with ensuring that the raw material is made available to the factory unit, and once the process units are ready, how they are made available to the customer. So overall, this process has become too much important because smooth flow of the raw material as well as goods makes the business sustainable. Once there is any blockage, the business will collapse. Then it becomes merger acquisition, and then it becomes the corporate restructuring that I have discussed with you. The next is environmental, social, and governance financing. So what is ESG? When we talk about the ESG, students, please remember it is kind of a strategy where we normally cover how we have to see we have to comply with the environment, social, and governance. So, sorry. So all aspects have been covered here. Of course, there is a theory is there. You can refer the same. Then it comes the strategic financial management decision making. Now, when we talk about the strategic financial decision making, we have to see what is our realistic strategy, financial resources we have to see, right management team. So all this theoretical topic has been covered here. You just refer the same. Then it comes the strategy management strategy. When we talk about the strategy, the basic rule we have to apply risk return trade-off. Okay, we have to see, we have to accept that level. See, risk return trade-off is exactly what is this term will be utilized. We shall refer in our overall discussion. A question comes, what exactly is this is all about risk return trade-off? It means, suppose if my return is 15% on any project. Okay, and risk is say 10%. Okay, now on the other project, my return is 12% and risk is the same. So of course, I will go for this. I will not go for this project. I will go for this project because risk is the same, but return is higher. Similarly, if I say for a project, if I am getting a risk of 12% in a both project, return is in a both project is 12%, and risk in this project is 8, and here in this project is 10%. Here it is risk is 8%. So it is risk, it is return. Okay. So now I will say for which project I should go. I will say that so same return, lesser risk, same risk, higher return. So this is called risk return trade-off. So this risk return trade-off is very important because we have to see how we can deal with the same. Okay. Just I think 2 minutes. I will take the break. Don't worry. Then it comes the functions of the strategic financial management. Okay, so all theories have been covered here. You can refer the same. What are the various financial decisions we have to make? Okay, so all the basically theoretical decisions are there. Then we comes to the key decision within the scope of financial strategy. Generally, these are financial decision, investment decision, dividend decision, and portfolio decision. Of course, student, these decisions you must have covered at your intermediate level. This is portfolio decision is new to you because here I have give you, I have mentioned you the importance of the diversification. Okay, so here sometime what happens, even a company may divert into another business. Here the importance of the diversification come into the picture. Okay, so that's why here it is covered here. Next is come the strategy at different hierarchy levels. So there are 3 levels basically. You must have gone through at your strategic management paper at intermediate level, corporate level, at business unit level, and functional level. Okay, when I talk about the corporate level, okay, so basically corporate level is a kind where overall, if I say like a group ITC, okay, now ITC may have a different kind of a business. Overall, they may have a strategy like we have to increase our profit, etc. So ultimately, what steps they have to take that acquiring another business, or sometimes they may decide that a big generally here in the corporate level strategy, the constituents are the generally the person are concerned with the CEOs, board members. Okay, they are generally the at a corporate level, and in the corporate level, what they do, they have to see uh, how we have to say some combat some challenge, or how we have to make a growth. So by this, they may take a decision that of course we should take this business. So all decisions are taken at this corporate level unit. Okay, now next it comes the business unit level. Now like ITC, they may have a FMCG unit, they may have a hotels, okay, they may have a paper unit. So this comes the business unit levels. This comes the business unit level. So accordingly, now different business may have a different perspective. See, corporate have a broad perspective. Then whatever the corporate have decided, the business unit level have to implement them. Okay, now here they have to compete with the market, because how they have to compete with the market, because now if ITC in the FMCG goods, now they may have to compete with the Unilever. So there the business unit level decide the same. Okay, student, I am just taking a small break of 10 minutes. Okay, after this, I will continue my discussion, and the assignment has already been uploaded on the website. You can download the same. I hope you must have downloaded. So we shall, after I think 10 to 15 minutes, we will start discussing the questions as well. Okay, student, and we are going for a small break. Ashok ji, अशोक जी, देख सर। Okay, student, welcome back after the break. Now, as we were discussing this strategic business unit level, so we have seen that different business have different objectives and they normally compete with the market. Now, next week comes the functional level strategy. Now, these are strategies are associated in the business unit itself. We may have at different levels, okay, where they compete, not they compete, rather they facilitate the business unit managers to achieve the targets. Similar for this, they have a different functional units like research and development, marketing, finance, okay, HR. So all these are functional units. So here we have to see what are the functional strategies we have to see. Now next we discuss about the financial planning. Now once we start with about our strategic decision making, the financial planning plays an important role. Now financial planning is basically encompasses the business planning and corporate planning. Okay, so business planning, of course, what we have to, in which business we have to go. Then after that, for corporate planning, basically corporate planning is a broader, and business planning, you can say it is a part of the corporate planning. Now we have to see, and ultimately, what is our objective? Our objective is to use the existing financial resources to the achieving our financial goal. So first we have to see the three components are financial resources, financial tools, and financial goals. So all these are theoretical, and this is basically interface of financial policy and strategic management. The interface of strategic policy and financial strategic management, financial policy. If we understand this very point, the starting point of an organization is money, and the end point of organization is also the money. So of course, the organization start with the source of money, and ultimately it ends with the dividend distribution. Okay, so it is ultimately dividing the money among the we can say the investors. So this objective we know, once we are clear with this, so accordingly we can take the decisions how we have to do this, starting from the acquisition of the fund till the satisfaction of the claims of the investors. Now when we, further we have talk about, if we both go in detail, so we have to see what are the desired mix of the equity and debt capital, okay, and generally what kind of a different decisions we have to take like addition of the new product in the line, okay, exit merger acquisition kind of a things. So all these are covered here. Now when we talk about our financial planning, that I have in the beginning I have told you that one of the very important concept is balancing financial goals versus sustainable growth rate. Now, what is sustainable growth rate? Sustainable growth rate, as I told you, it is basically the rate that can be sustained for a longer time. Okay, too slow, too fast, too slow growth will go against enterprise growth and development. Because see, if the growth is too slow, of course, it is also dangerous for the organization because it will collapse your organization. Too fast means it is very quite become difficult to maintain the same growth rate, then it also becomes a reputational risk. So ultimately, to make the it is always better to have a sustainable growth rate, and our we have to draft a suitable financial policy so that our growth sustainable growth rate can be maintained. Strong concept of sustainability is concerned with the preservation of the resources under the primacy of the ecosystem. Here it comes the concept of, we can say, growth with the ESG concept here. Okay, so student, with this we start. What are our key growth rate that are normally considered for our discussion? There are basically student, there are two type of a growth rate. One is internal growth rate and another is sustainable growth rate. Okay, when we talk about the internal growth rate, it is basically concerned with the how much we can grow with the internally generated funds. Now, if I say internally generated funds, Of course, what are internal generated funds? It is the retained earning. It is the retained earning. Once the retained earning are plowed back in the business, the growth is there. If you recall that in your intermediate level, in a dividend chapter, there is a one Walters model. Okay, there the what is the Walters model basis? It says that if the company's growth rate, if the rate of return of investment on the company internal, if the dividend is reinvested and if the company's rate return of investment is more than your cost of equity, then you should invest in the business, reinvest in the business. Dividend policy should be minimum dividend. Okay, because shareholders are more interested in saying that you just invest in the same business so that we get the more appreciation in our funds. So that's a retained earning is one of the very we can say is linked with the internal growth rate. Internal growth rate is the maximum growth rate that can be achieved with no external financing whatsoever. So it is the basis, no external funding. Growth rate that can be strengthened with the retained earning represents the internal finance. So of course, it is one of the sustainable growth rate, but it is generally with the own sources. Okay. When we determine the internal growth rate, we make the following assumptions. One is the firm assets of the firm will increase proportionately to the sales. Net profit margin is a constant. The dividend payout ratio is given, and firm will not raise. So it is one of the very prime importance that asset of the firm will increase in proportionality to the sales, because once the sales in the proportionality of the sales assets are increased, more and more our fund are reinvested. Okay, and for this reinvestment we use the internal funds. Of course, dividend payout ratio generally is indicated by D. So retained earning is generally indicated by 1 minus D. Okay, now we come to the variables of internal growth rate. So how we internal growth rate determine? First is net profit margin. Okay, net profit margin is generally net profit okay, net profit divided by sales. Then asset turnover ratio of sales revenue to the total assets, and the retention ratio that I have discussed 1 by B. Now the formula is there. Okay, first we compute the return on asset. First we compute return on asset, and formula for this is net profit margin into asset turnover ratio. So net profit margin is basically net profit okay, asset turnover ratio basically sales divided by asset. Okay, so when it got cancelled out sales, it becomes net profit on the assets. So okay, so we get return on asset here. IGR basically return plowback ratio means 1 minus dividend ratio. So it gives you as the dividend IGR internal growth rate. Okay, student. Now very important to note here. There is this is 1 minus D. There is another approach is also used. You will also see in some books where this formula is also there. Okay, student. So This formula can also be used in the examination as well, no problem. Okay, I'm just sharing with you one case scenario. Okay, just read out the case scenario and answer the question. Just this is a slide is there. There is a S limited company with a stable financial performance, and management is keen on understanding how much company can grow using only its internal resources without taking any external finance. The company's financial data for the year is as follows. The net profit ratio is there with available with us. Okay, dividend payout ratio is there. Okay, asset turnover ratio is there. Asset to equity ratio is there. Okay, the board of directors wants to explore this growth rate to help to the planning the future expansion. Now, based on the above information, the internal growth rate of S Limited shall approximately considering that no external financing shall be availed, relying solely on the retained earning and its existing base. Okay, students. So please take your time. Okay, and give me the correct answer. I'm just sharing with you the financials about the company. Net profit ratio. Okay, I do one thing here. I write it here. Net profit ratio is 6%. Okay, dividend payout is 40%. That is D. Okay, then it comes the asset turnover ratio. One 1.40. Last ratio will not be used. So just share your answer, beta. Okay, I am receiving correct answers on my screen. Yes, most of the student is giving the correct answer. First of all, our profit earning ratio is basically 6%. Okay, this is our asset turnover ratio. So accordingly, this become our return on the asset. Okay, into 1 minus dividend is 40%. So our retention is 60. Accordingly, this value becomes our correct option will be 5.04. Okay, student. Now I am coming to the next concept, that is sustainable growth rate. Now, sustainable growth rate, what is exactly is this? Sustainable growth rate is a rate at which the firm can grow using the 1 second. Choosing the internal retained earning as well as additional external debt, but without increasing his financial leverage. Now, student, when I talk about the financial leverage, you have heard this term and you are, or I think you may be very well discussed, or you uh, have gained the knowledge about this term at your intermediate level. What is financial leverage? Basically, it is the inclusion of the debts in the cost capital structure. So here, very important to note that your financial leverage should not be increased, because what happens when we talk about financial leverage, it is basically uh, the introduction, or we can say level of increasing the level of the debt in the cost of capital structure. Because why we do it? Because generally the cost of debt is lesser than the cost of equity. Accordingly, what happens when we increase the cost of debt in our cost structure, we take the tax benefit, and ultimately the profit available for the equity shareholders becomes on a higher side. However, it works also opposite direction. So that's why financial leverage is said to be a double-edged sword. Double-edged sword. So here, sustainable growth rate is basically, we can say it is a rate that is that can be by this firm should can grow by using internal as well as external funding, but keeping itself within the purview of the base within the purview of only the uh, financial leverage limitation. That is very important. Financial leverage should not increase. Debt equity ratio should not be changed. Okay. Sustainable growth model assumes that business wants to maintain target capital structure without issuing the new equity. Okay. Maintain a target payment day ratio and increase sales as rapidly as the market conditions allow. Okay, so what they say, we have to increase the debt, but that should not be that much, that without increasing the new equity. We don't want to issue the equity, and we have to maintain the our debt payout ratio, increasing the sales rapidly as market allow. To determine our SDR, we have to make some additional assumption that the target capital structure which it wants to maintain, very important, debt equity ratio shall not be changed, and firm does not want to sell the new equity as it is closely sourced. So now see, uh, we can see that the company wishes to maintain a particular debt equity ratio and unwilling to, it is other way around. Okay, so how it is calculated, let us see. The formula for computing this sustainable growth rate is simple. That is ROI into B. B means retention ratio, or another version of the same formula that we have been used earlier can also be used here. Okay. Now, how we compute the return on equity? Very simple. If you recall that this formula is also called DuPont formula. Okay, this is also called DuPont formula that you have covered at your intermediate level. Here, this is basically your net profit ratio. Okay, this is sales turnover ratio. Okay, and this is equity multiplier. This is your equity multiplier. So it is a kind of a equity multiplier. Okay, it is basically asset turnover ratio, and this is your profit margin ratio. So by this, we can say that we cancel out the sales. Here we cancel out the equity. So ultimately it becomes how much I am earning on my equity. Okay, so that is called return on equity. Okay, student. So I am just same case scenario, just slightly some difference there is there. Okay, just read out the case, and then we will answer this MCQ. Then we will proceed further for the assignment question. It says that S Limited is a company with a stable financial performance. The company's financial data is as follows. Okay, 6% net equity ratio, net profit ratio. Okay, dividend payout is 40%. Okay, asset turnover ratio is 1 point, and here it is equity ratio. So you remember that these three variables we have used in computation of internal growth rate. Now here this additional item will be used where the board of director wants to explore this growth rate to help the growth rate to help plan to future expansion strategy. Based on the above case scenario, the growth rate of S Limited can sustain without increasing leverage shall be approximately. Okay, so here we shall see how we can increasing financial leverage. We have to what rate we can achieve. Okay, and we can increase our leverage, but that we can use the external finding, but we shall not use the equity. We shall use only debt. Okay, accordingly, what will be the answer? Okay, student, please take your time, just 2 minutes. Okay, I'm just writing down here again. Okay, equity multiplier is 2. Student has started answering the same, and I am receiving the most of the responses are correct. Yes, the correct answer is B option. How we have completed here? I am just showing here. Okay, student. So the correct option is so student. Now with this, I am coming to the assignment. Okay, this is the question number 1. Just read out the question. Okay, then we shall start solving the same. Yes, Sahil, Alka, and Anita. Yes, you are right, beta. One second. There is one student is asking. Uh, once Ankita is saying, sir, where the assignment is available. Beta, it is available in your BUS knowledge portal. Okay. Sorry, Priyanka, I could not show. You have said, sir. Sir, show the formula once again. Just let me show. Which formula, beta, you are asking? Priyanka, Dev. I think you must be asking for formula. Just let me- I think you may be asking for this. This is the formula is there. Net IGR, IRR. Priyanka, beta, it is not IRR. It is internal growth rate. It is IGR. It is not IRR, beta. Okay, this is a formula for IGR. Yeah, yeah. Okay. Okay, student. Now I'm coming back to the assignment. Now it says like that the following financial data is available for PQR Limited for the financial year ending 2018. Okay, debenture having issued debenture amount is 125. This is the 10%, and this has been issued in 2017. Okay, equity shares are rupees. This is 100 lakh. Reserve and surplus, total assets, asset turnover ratio, effective interest rate. Now this is very important figure. That is I show how we shall use it here. Okay, then effective tax rate. Okay, then operating margin. Okay, then it is the dividend payout ratio and current price of the share and requirement rate. So what we are required to do, first of all, it is asking us to draw out the income statement for the year. Okay, then it is says calculate the sustainable growth rate of the earning SGR. Okay. अशोक जी वॉइस में कोई इशू आ रहा है क्या? अच्छा, ओके ओके ओके। अच्छा अच्छा, ठीक है ठीक है। आई विल सी वन थिंग। आई आई ओके, अब देखना, मुझे बताना जब मैं लिखूंगा ना। अभी क्लियर है वॉइस? ठीक है, ओके ओके स्टूडेंट, नाउ लेट अस स्टार्ट सॉल्विंग द क्वेश्चन। ओके, so first of all we have to draw out the income statement. We have to draw out the income statement, and for drawing out the income statement we have of course data with us, because we have a sales with us. Okay, we have to compute the, we have to sales with us. This is total assets. Okay, this is asset turnover ratio. So what we shall use? We shall use this figure to compute the sales figure, because this is the prerequisite. This is the prerequisite for computing the sales. Okay, now let us start preparing the. Okay, student. Now let us start first of all. Figure with the sales figure. Now sales figure. How we shall compute the sales figure? Student, total assets is 600. Okay, and our asset turnover ratio means what is the sales? Sales is the time of asset. So accordingly, our 1.1, so our sale will be 660 lakh. Okay, student. If you have any doubt, so please discuss with me. Ask to me. I thank you. Just reminding me, my voice is low. Even you find it anywhere, please let me during the classes. So student, here it is a 660 lakh. Okay, now next it comes the operating expenses. Now, how we shall compute the operating expenses? We have an operating margin here. So if I deduct it from the sales, I will get the operating expenses. Of course, it is the 90% of the sales. Student, all these ratios you have gone through at your intermediate level. So I don't think you may be finding it any difficulty. Okay, student. Till now, I think it is clear to you. Now, next we come to the figure of interest rate. Now, here interest it is writing as it is effective interest rate is 8%. Okay, but you will say, sir, of course, for bond don't have any issue because we have been given the figure of 8%. But a question comes, we have been given the issue figure of 10%. So student, please note that we will consider only 8% for the overall amount. Okay, the total amount is come 175. Okay, we shall take 8% of the same. I will just discuss with you the logic. Just have patience for 2 minutes only. Okay, so what I do, I compute this figure 175 at the rate of 8%. The figure comes so this will be profit earning before tax. Okay, now student, if I ask you, of course, these bonds have been issued somewhere in 2017. Okay, why it has been mentioned so? Because see, if I compute this figure separately, I just show you my interest is 175 into 8%, and the figure is coming 14. Now this figure consists of two interest charges. One is 8% for 1 to 5, that is rupees 1 lakh, and balance for rupees 175 lakh. Okay, so if I multiply this, compute this amount comes 10. This amount comes 10. Okay, not 75 lakh, it is 50 lakh. My mistake. Okay, now here the balance is this is 14. So for 50 lakh, I have paid the interest of rupees 4 lakh. Okay, I have paid the interest of 4 lakh for this. Okay, now question comes, when I have how much for how much period the interest has been charged from me. From me, I have been charged the interest 4 by 5 because if I take the complete interest. So my interest will be at the rate of 5%, 10%. The amount will be this much, and I will do like this. Okay, so ultimately, I am paying the interest for the period of 9.6 months. So even we can came to know what time we have issued the equity. We have issued the additional debt. So I hope it is just for your knowledge only. Here we have computed this here. Okay, now next we given the tax. Okay, this will be earning after tax. Okay, now we can see we shall deduct the dividend at the rate of 16.67. So if I compute 16.67%, it will become 5.2 lakhs. So the retained earning will be 26 lakhs within me. Okay, student. So this will be the balance left with me from as an internal source. Okay. Now, since I have to compute the sustainable growth rate, what I do, I compute it by SGR is equal to return on equity into 1 minus B. Okay. So how I will compute return on equity? First of all, I will compute my net worth. My net worth is basically equity share plus reserve and surplus. That is okay. So my net worth is rupees 400 lakh. Okay. Profit after tax. That is earning after tax. Okay. My profit after tax is 31 lakh, 31.2 lakh. Accordingly, my ROE will be okay. So I am now going, I have computed my ROE, and what I will do, I will multiply it with the 1 minus dividend payout ratio. Okay. Alternatively, other formula. Okay, student. So this was the first portion of your assignment. Now I am coming back to the presentation. Thereby I will discuss the concept of external funding requirement. Then I will proceed for the remaining portions of the assignment. Now there is another concept, external funding requirement. Student, please note that this external funding requirement as such is not directly covered in the study material. Okay. However, there is one time the question has come in the under the old scheme examination, and that's why I decided that I should cover it here. Student, what is external funding requirement? See what happens. We have seen in the internal growth rate and sustainable growth rate. In our first internal growth rate, we are considering that our sale, we are not using any outside resources, external resources. However, it's sometime and in the sustainable growth rate, we are assuming that we shall use the external growth rate, but not equity, and that will our debt equity ratio should be remain maintained. Now, what happened? Sometime our firm grows automatically. Okay, our firm grows automatically, and we have to see how much fund we have to generate externally. Of course, if we want to maintain some sustainable growth rate that our leverage is not affected, so then it is a sustainable growth rate. But sometimes there are some growth in the business automatically. Now to capture this growth, okay, we have to do make the some may take some external funding from the outside. Now here, one of the very important assumption of the sustainable growth rate we have to ignore, or we can say it works other way around. Like here in sustainable growth rate, normally we are company is unwilling to issue new equity share, but sometimes we have to see that we have to issue new equity shares. Okay, or sometime what happens? Of course, while sustainable growth rate, we have seen that our debt equity ratio should not be affected. We have it is one of the conditions, but sometimes there may be a variation in the conditions. Okay, our debt equity ratio will be this much of only amount. So when there is a variation in these conditions, then the concept of external funding requirement comes into the picture, where we have to see how much we have to generate funds from outside so that our conditions are met. Okay, so that is called external funding, and that is one of the very important aspect of financial forecasting, as well as element of financial planning. So that's why this topic is covered here, so that you may come to know how we may carry out this analysis. Okay, even we have to see how much future funding we shall require. Now, generally, there are four steps are involved in this external funding requirement. First is forecasting the firm sales, as most of the other forecast budget follow it. Sometimes it is also called, you can say that when we talk about the budgeting, in the budgeting part, the first comes the sales budget. After that, other budgets comes because sales determines the other variables. Making projections for the additional variables such as this, estimate the level of investment in current fixed asset to support the projected sales. Now, what happens sometimes? Our assets are also increased, are need to be increased for achieving some sales level. So that we have to see how much increase shall be there. It can be in the tandem, or it is equal to the sales increase, or it can be more or less. We have to see asset increase. Then determining the, so basically broadly, we have to follow this approach. Okay. Now, let us see. Hence, an existing firm can plan for the forthcoming, assuming that the sales will be increased by 12%. There will be a reduction of about by the 5% in selling price. There is an increase in the labor cost by 5%, and so on. So we have a different elements. Okay, IGR or AGR are, we can say SGR and IGR, both are broad growth rates that can be achieved. But here we are doing some minute analysis. Okay, so from this, it becomes little bit complicated. So normally now question rises, how we can use the external funding, we compute this. Generally, what we do, we use the percentage of sales method. By what percentage our sales is increasing, accordingly, we change our forecast. Okay, we incorporate this change in our forecast and compute the amount of external funding requirement accordingly. The method works on the simple logic that various expenses, asset liabilities for the forecasted period change in the same percentage. Very important. In the same percentage as a change in sales. Okay, so this method assume by whatever percentage our sales will change, our say other variables will also change. And using these percentage, develop a pro forma balance sheet and determine the external funding requirement. Okay, students. So this is also called analytical approach. Okay, start changing the items linked. Okay, that is, we have seen that we change other item and sales and then follow the liquidity and debt structure. Then another approach is a formula is also there. Okay, there is another, a formula is there, formula for computing EFR. Now, if I talk about this formula, student, it is not exactly the formula. It is basically a simple logic. And when we start solving the question, you will say, sir, I will not need to cram the formula. Now, see, student, what happens in the paper of AFM, it is always said that there are many formulas. But if you really ask me, hardly there are 2 or 3 formulas that you need to cram upon. Otherwise, everything is logical driven. So once you understand the logic behind it, you know to cram the formulas. Okay, all are rubbish. Say there are some coaching people are distributing the formula, formula book, etc. Nothing. Hardly 2 or 3 formulas that are available in the study material. Other formulas are logical based, and once you go through them, you will understand there is no need to cram them. So here it is the formula. First it is set total asset to sales ratio, and that is change in asset. Okay, increase in sales. Then current liabilities and provisions spontaneous to this. Now here we make the assumption. Okay, this spontaneous assumption is very important. Now, student, if you recall that even in your working capital management, it is said that generally it is assumed that our current liabilities also increase in tandem with the current assets. So accordingly, a part of the current asset need is financed by our current liabilities. Similarly, working capital requirement, a part of the sales increase will also lead to increase in the current assets, current working capital, current assets minus current liabilities. So it is generally assumed. Accordingly, liabilities and the provisions are also increased in the same ratio. Okay. Total assets, here it covers your fixed assets as well as current assets. Here a portion is current liabilities is compensated. Okay. Minus profit margin ratio and projected sales for the forecasted period. This will be our new sale, and 1 minus D, that is dividend percentage of the. So this is basically a retention ratio. You can say it is the retention ratio. Okay, it is a retention ratio. So by this we can compute the how much will be our external funding requirement. Okay, student. Now you just note down its formula if you want it. Otherwise, once I will solve the question, I will use this formula. Is it very? And if you see that basically this is the increase in the fixed asset current as well as current and fixed assets, and this is the part of finance by our current assets, financed by the current liabilities. The overall increase this much of it is there, and this much of it will be funding by our internal sources. The rest will be our external. So this will be more clear to you, and I just show you by a way of diagram also, it will be more clear to you. I'm just presenting the diagram here. This is required external funds. In the sideline, I have written required external funds. This is growth rate. Okay. This portion is retained earning. Okay, now students, please see here. Now suppose if there is a no growth, okay, there is no growth. So whatever be the retained earning, that will be used to repay the debt or buy back equity. Okay, as growth will be start there. Okay, as the growth will start moving, we shall start using our retained earning. Okay, however, if we pay some dividend, okay, so our growth will be there. Okay, similarly, here at this point will be internal growth rate. Because here we are using our internal sources. These are our internal sources that we are using. So ultimately we can achieve here the internal growth rate. Now once we cross it, okay, once we cross it, so we need external funds. We need external funds. This portion is basically external funds, or I say I do it with a different color. So this is the, here we will need the external required external funds. Now here, if it can be sustainable growth rate somewhere lying here. Sustainable growth rate may be lying here. Okay, because we have to maintain debt equity ratio. That we don't know from here. But here we know that if we have to achieve this growth rate, so we have to, this much of required funds will be there. So this is a by way of diagrammatic presentation. I will discuss with you with the help of a assignment questions. So now I am discussing with you the second number question of our assignment. This question has been adopted from the earlier examination. That is another old scheme. Okay, so just read the question carefully. Student, discussion on the assignment shall be continued in the next class also. Okay, when I will take up the second topic. Okay, there this I will first in the first, I think half an hour or so, 45 minutes. I will complete this assignment. Then I will continue the topic on the risk management. Now question says like that, the balance sheet of Messrs Sundry Limited as on 31st March 2020 is as follows. Okay, now this item has been given to you. Share capital is there. Okay, reserves is there, long-term loans, etc. has been there. Here on the asset side, fixed assets, inventory. So all these are our assets or current assets. Here, these items are our current liabilities. Okay, sales for the year was 600 lakh. the sales expected to grow by 20% during the year. Now see, here you expect that there is some growth. Okay, this is not in your end, you are expecting that. There may be a number of reasons like growth in the economy, maybe the elimination of the competitor, whatever be the reason. The profit margin ratio and dividend payout ratio are expected to be 40%, 4%, and 50%. The company further desired that during the current year, sales to short-term loan and payables and provision should be in the ratio of 4:3. Now here in SGR there is only one condition, that it should be leveraged only there. Financial leverage should not be distorted. But here there are other conditions as well, not relating to that. They maybe say their own conditions. Ratio of fixed assets to long-term loans should be 1.5. Okay. Then it says debt equity ratio should not exceed 1.5. Okay. Right now the debt equity ratio may be different. Okay. We are not going on that, but they say it should not exceed 1.5. So now they have given us the condition. Okay. So with this, we have to determine first of all how much funds we shall require, external funding requirement that we have to meet from the external sources. External sources can be long-term equity, long-term debt, as well as equity, fresh equity. Both are inclusive. Okay, then amount of long-term, short-term, even short-term, that is from external sources, long-term and equity funds. Okay, so now let us start solving the question. First of all, we have to draw out the modified income statement. Now here our year was 2020. Okay, so modified income statement shall be 21. Okay, because in the coming year it is expected to rise. So my mistake, student. I have started solving the third question. I'm sorry. That sorry, students. I have mistakenly taken up the third question. First of all, let us discuss the question number second. Then I'm going to the question number third. Quickly go through the question, because third question is quite lengthy question. Just read the question carefully so that I can. Now this question says the following balance sheet pertains to the ABC Limited. Okay, here it is has been given to us. Okay, balance sheet is there. Then income statement for the current year has been given to us. Okay. Assume that next year the sale will increase by 15%. What will be the modified income statement? And also prepare the revised balance sheet of ABS Limited and analyze an EFR under the following three scenarios, assuming the increase in sale by 15%. So now here we have been given this figure for the 31st March 2021. In the next year, we are assuming our sale will be increased by 15%. Accordingly, we have to prepare modified income statement, and then we will see what will be the modified balance sheet as well as our modified income state. What will be our external funding requirement. Okay, so let us see the solution. Here it is 31st March 2021. So the income will be modified and will stand for the 31st March 2022. Student, here you are seeing that I am using the scale, and my request to you that in the examination as well, you just carry the scale with you, ruler scale with you, so that your presentation for the tables are quite neat. Sometimes I have seen that in the answer books, students have not used the proper table. This is not clearly legible. The answers are not legible. So that's why sometimes, of course, their answer need to be legible. It is essential that for ruler scale should be used for the table. Okay, student. Now here you see our sales is 1 lakh 35,000. 1 crore 35 lakh 80,000. Now I will add the 15% increase in the same. Okay. So accordingly, my new sales will be okay. Now less cost of goods sold. You can carry out this calculation along with me. And if I am incorrect on any place, please do let me know. Along with me, you start noting the same. And if any, just also carry out your calculation. And if I am wrong at any place, you just get here the difference will be my profit. Okay, gross profit. Okay, now my indirect expenses already has been given to me. Okay, so I will assume that this will also increase in the same percentage basis. Okay, so this will be our EBIT. Next, we deduct the interest. Okay, 12%. Okay, this is amount is here 29, 72, 250. Okay, less tax at the rate of 42%. So it comes for 12, 48, 345. So net figure earning after tax comes 1723,905. Okay, now here we have come out with the first part of the our question, that is we have to prepare modified income statement. Now next question comes that how much our external funding shall be required if there is no change in the fixed asset in the proportion of sales and no dividend is declared. Okay, so let us first prepare the balance sheet, then I will show you how we come to the external funding requirement. So first I am preparing balance sheet. Okay, I am just preparing the balance sheet on this base. Okay, and then I will show you by the way of formula, etc. Today only first part we shall cover here. Here it comes, scenario one. Okay, here it comes what it says. The no change in fixed assets in proportion of sales and no dividend is declared. Okay, so let us see what will be the position. Our profit after tax is, please remember, it is profit after tax is here 7. Okay, now net fixed assets here our in the balance sheet was 2466. It will remain same, but here there will be change in 15% here. Okay, and here there will be a change increase in 15% here. So accordingly, I just consider this change in the my balance sheet. Fixed assets. Okay, current assets increased by 15%. Okay, so cash will be increased by 15%. I'm just increasing all the figures by 15%. Okay, the total comes here 65 lakh 31,000. Clear? Now I write down the here the equity figure. Okay, I write down here 45 lakh. Okay, now what I do here, my retained earning is there is no my earlier there was no reserve and surplus. Here there was no reserve and surplus. So whatever be my retained earning here, I will show it as a reserve. Okay. Now for the long-term debts, I'm not writing any figure here. Okay. I'm just writing here figure. First of all, I'm taking the current liabilities. And it here our accounts payable. So these are also increased by 15%. Please remember, these has also been increased by 15%. Okay, this is our outstanding expenses. Okay, now my balance sheet total here is 65 lakh 31,000. I write this figure. Okay, now this figure is with me, this figure is with me, this figure is with me. Now here I will write the long-term debt as a balancing figure and I will compute this figure. The answer comes 111,595. Okay, now you will say, sir, here our long-term debt is 13 lakh 30,000, but in the modified balance sheet, it says this figure is coming 1,11,595. Student, that is basically, it is not the external funding requirement, that is rather paying back to the debts. It is paying back to the debt that I have shown you by way of diagram. Okay, that I have shown you by way of a diagram. If you see that, here I have shown to you. Now this is here, your line somewhere here. Okay, so this will be has been used to your repay the debt. So by this growth rate, you are ultimately, if we are assuming, so these are the factors. Okay, these are the factors we are assuming. Okay, student. So this is now I will show you how we have computed by using the formula. Okay. Now I am showing you by using the formula. Okay. Just a second. Now my change in the assets. Okay, this is basically change in the overall asset. So please see, student, here. Since there is no change in the fixed assets, whatever change is taking place, that is taking place only in the current assets. So my current asset change is 5,31,000. My change in the current liabilities and provision, here this amount is changing. My 25 lakh minus how much I am retaining the profit? No profit. See here, my whatever be the profit. Okay, my whatever be the my profit. Okay, I am declaring no dividend. Okay, so whatever be the left, that is here. So if I compute this figure becomes negative figures of. So this negative indicate that I will use this amount as a refund. Okay, my existing debt is 30 lakh, 13 lakh, 30,000. Okay, this much of amount has been used to refund. So balance left is 1,11,595. Okay, student. So this is the amount. I just write it in a blank ink. Just 2 seconds. So ultimately, the balance left is with me 1,11,595. This will be the, so less here. Yeah, this is existing debt, sorry. So it is EFR. So ultimately, this amount is matching. Anila is asking, sir, why? What about the interest? See, beta, interest is there. 12% we have taken because this interest is for the complete year. We have used the debt of 13,30,000 for the complete year. Okay, and we have paid this much of interest because interest figure has been given to us here. This figure has been given to us. Okay. So we are considering the same interest, that is, there is no change in the debt. Okay, but whatever be the change, some will come from the here from the interest, it will be used. Okay, and why there is no change? Because other we have given only there will be no change in the fixed asset, and there will, that's why we are considering the same. I hope it is clear to you. Till you have any doubt, you can ask me. Okay, students. So we can see that how we have arrived this figure. Now, if I said you logically, if we go by the logically, we can also get the answer logically. Overall, if we see the increase on our assets, and I'm just going by the logic, overall increase is in current assets. Current assets and spontaneous increase is financed by the current liabilities. Okay, so overall the increase in current assets was 3,54,000. Okay, sorry, 35 lakh. 1 minute. Okay, overall our current assets was 35 lakh 40,000. Our current liabilities was 1,70,000. So this was our working capital. Okay, this was our working capital. Now there is a 15% increase in working capital. So the increase comes 5 lakh 5,500. Okay, now see, our profit after tax is basically 17 lakh 23,905. Okay, out of this, we have met out this 5 lakh 5,500 requirement of funds from this POT. The balance rupees 12 lakh has been left with us. Okay, that has been left with us. Now, when it has been left with us, what we do? We use it to refund the long-term loans. Okay, we used to refund the loan, and that's the amount coming here. Okay, student. With this, we come to the end of this today's session. Of course, if you have any query, you can send it through the mobile app, or you can send us the email at sfm-final@icai.in, or even you can contact me at our mobile landline number. This is STD code for the Noida. Okay, and this is my telephone number. So even you can contact me on the telephone number. Okay, with this, student, we come to the end of the session, and I hope whatever has been discussed in the class. Of course, I have give you a brief about the syllabus, and I have started discussing about the concept of sustainable growth rate, internal growth rate. So you can refer your first chapter from the study material and prepare yourself for the same. Student, we shall continue discussion on the same assignment in the next class. Then we shall take up the second topic. Okay, student, let me check whether I have received more query, or then I will close my session. Just 1 second. Venkat is Venkatash Baban Shinde. Yes. Does sustainable growth rate need to be lower than IGR? As we are saying, SGR is a long-term rate, so business could be more careful to disclose higher growth rate as SGR. Sustainable growth rate, yes, to some extent, sustainable growth rate, you have to see that ultimately you may not go to the loss. Means you need to maintain. So that's why you have to see how much we can maintain by using the external funding, but not increasing our. So we should, whenever we disclose our growth rate, that should be kept keeping in view our funding requirement, everything. This is a kind of a strategic concept. Okay, there are other factors can also play the well role. Of course, the formula is there. So still, if you have any clarity, you can contact me over there, Venkatesh, so that I can understand what your perspective on your query. Okay, student. With this, we come to the end of the session, and we shall meet you in the next class. Thank you. Have a nice day. Yeah, session is over.